$2 billion. That's what Apple must pay UK iPhone users for overcharging them on the App Store. 36 million people are getting refunds averaging $55 each. If you're in the United States and you paid the exact same App Store fees, you're getting nothing. Welcome to Patent Wars, where tech economics, market impact, and financial strategy collide. And nothing is ever as simple as it looks. Same company, same App Store, same fees. But in the UK, consumers win $2 billion. In the US, Apple walks away untouched. Today, I'll show you exactly why the UK enforces antitrust law while America protects monopolies. Let's set the stage. October 2025. The UK's Competition Appeal Tribunal issues a unanimous ruling. Apple abused its dominant market position. The 30% commission it charges developers is excessive and unfair. The harm to consumers between 2015 and 2024 is valued at £1.5 billion, roughly $2 billion US. 36 million UK iPhone and iPad users are eligible for compensation. The average payout will be around $55 per person. Now here's what makes this remarkable. This isn't some fringe theory. This isn't activist judges making up numbers. The tribunal used economic analysis, compared Apple's App Store to competitive markets, and determined that fair commission rates would be approximately 17.5% for app sales and 10% for in-app purchases, not 30%. The tribunal even admitted it used what it called informed guesswork, but that guesswork was based on verifiable market data from less monopolistic platforms. This is economics, and not ideology. Apple immediately appealed, first to the same tribunal that ruled against them. The tribunal refused in November 2025. Then, just 2 days ago on December 28th, Apple escalated to the UK's Court of Appeal. They're arguing the tribunal made errors in law, that Android provides competition, and that the calculation method was flawed. But here's the uncomfortable question nobody's asking. If the UK can prove Apple overcharged consumers and force a $2 billion refund, why can't the United States? Because the US tried. Multiple times, and Apple won. But to understand why, we need to follow the money and compare the two legal systems side by side. This didn't start in October 2025. The UK case was filed in 2021 by a researcher named Dr. Rachel Kent on behalf of millions of UK consumers. It took 4 years to reach trial. During that time, Apple's defense was consistent. We're not a monopoly. Users can choose Android. The 30% fee reflects the value we provide through security, payment processing, and a premium marketplace. Developers agreed to our terms, and the App Store has distributed over $55 billion to UK developers alone. But the Competition Appeal Tribunal did something the US courts wouldn't. They calculated what Apple should have charged in a competitive market. The tribunal found that Apple's control over app distribution on iPhones and iPads allowed it to impose commission rates of up to 30% that were higher than would have prevailed in a competitive market. Now compare that to the United States. August 20th, 2020. Epic Games, the maker of Fortnite, sues Apple for the exact same behavior. They argue Apple's App Store is a monopoly. The 30% commission is anti-competitive. Apple forces developers to use its in-app payment system and prohibits them from telling users about cheaper alternatives. Epic deliberately violates Apple's rules, gets Fortnite banned, and files a federal antitrust lawsuit the same day. The case goes to trial in 2021, and Epic loses. Not completely, but on the core antitrust claims, Apple wins. The federal judge rules that Apple does not have a monopoly under the Sherman Antitrust Act because Android exists as an alternative. Epic appealed to the Ninth Circuit Court of Appeals in 2023. They lost again. They appealed to the Supreme Court in January 2024. The Supreme Court declined to hear the case. Game over. So what happened? The UK and the US had access to the same facts. 30% commission, no alternative app stores on iOS, developers locked into Apple's payment processing. But the outcomes couldn't be more different. In the UK, $2 billion to consumers. In the US, zero. The answer lies in how each country defines monopoly power and consumer harm. The US uses the Sherman Antitrust Act, which requires proving that Apple has monopoly power in a relevant market and that the conduct harms competition. The judge in the Epic case defined the relevant market as digital mobile gaming transactions. And because Android phones exist, Apple doesn't have a monopoly in that market. Case closed. The UK uses a different standard. The Competition Appeal Tribunal doesn't need to prove a monopoly in a broad market. It only needs to prove that Apple has a dominant position in app distribution for iOS devices and that it abused that position to charge excessive fees. And that's exactly what they found. But here's the part that reveals everything. The UK tribunal didn't just say Apple's fees were too high. They calculated what the fees should have been. 17.5% for app purchases, 10% for in-app purchases. How did they arrive at those numbers? They compared Apple's App Store to less restricted platforms. Payment processors like Stripe and PayPal charge around 3%. Platform costs, hosting, review processes add another 7 to 14% depending on the service. Factor in Apple's premium security and user experience, and you get to 17.5% maximum for app sales, 10% for simpler in-app purchases. Apple's 30% fee, the tribunal concluded, contains an excessive monopoly premium of 12 to 20 percentage points. Multiply that excessive premium across billions of transactions from 2015 to 2024, and you get $2 billion in consumer harm. The math is there. The US courts simply chose not to do it. Sound familiar? It should, because this pattern shows up everywhere tech monopolies are challenged. In the US, the focus is on whether alternatives exist in some broad market definition. In Europe and the UK, the focus is on whether a company with power over a specific platform abuses that power to extract excessive profits. It's the same behavior, different legal lens. Here's the first contrast. UK judges calculated the economic harm. They asked, what would this cost in a competitive market? US judges asked, is there a different phone you could buy? See the difference? One protects consumers from overcharging. The other protects the company's right to charge whatever it wants, as long as a competitor exists somewhere. Elite technology executives benefit from vague market definitions that let them dominate their own platforms. Meanwhile, ordinary consumers pay inflated prices with no recourse. Today, UK iPhone users are getting refunds. US iPhone users are still paying 30% on every app and in-app purchase with zero compensation. Same overcharge. Different country, different outcome. Apple's executives and shareholders protected themselves through lobbying and favorable US court precedents. Meanwhile, ordinary iPhone users in the United States paid an estimated $8 to $10 billion in excessive fees during the same period with no legal remedy. Today, the US Department of Justice is suing Apple in a separate antitrust case filed in March 2024, but that case won't include consumer refunds. It's about future conduct, not past harm. Let's dig into the Epic Games case because it shows exactly how Apple wins in the US. Epic didn't just argue Apple's fees were high, they presented evidence that Apple prohibits competing app stores, blocks alternative payment methods, and uses anti-steering rules to prevent developers from even telling users that cheaper options exist. Those are the same facts the UK tribunal used. But here's what the US judge ruled. Apple won on 9 out of 10 claims. The court found that Apple did not engage in unlawful tying, did not illegally maintain a monopoly under the Sherman Act, and that Epic failed to prove any substantially less restrictive alternative for Apple's business model. Epic's only win was under California state law, which found Apple's anti-steering provisions, rules that prevent developers from linking to external websites, were unfair business practices that forced Apple to allow external links. But Apple responded by charging a 27% commission on any purchase made within 7 days of a user clicking that external link. So Epic won the right to include a link. Apple just charges nearly the same fee anyway. And that's not consumer protection, that's legal maneuvering. And it's not just the UK. The European Union fined Apple €1.84 billion in March 2024 for similar App Store abuses in the music streaming market. That case was brought by Spotify. The EU concluded Apple restricted music app developers from informing users about cheaper subscription options outside the app. Again, the conduct was the same. The US, under the Sherman Act, would have focused on whether Spotify could compete on Android. The EU focused on whether Apple abused its control over iOS to harm competition and consumers. Sound familiar? The pattern is always there. US regulators define the market so broadly that Apple can always point to an alternative. European regulators define the market specifically, the iOS ecosystem, and ask whether Apple abused its power within that ecosystem. That's why Apple faces billion-dollar fines in Europe and the UK, but not in the United States. You're starting to see it now. This isn't about whether Apple's App Store is good or bad. It's about whether the legal system measures harm to consumers or harm to theoretical competition. The UK measured consumer harm in pounds and pence, $2 billion. The US measured hypothetical competition and decided that because Android exists, no monopoly power exists. But here's the question nobody in the US courts wanted to answer. If I own an iPhone, does it matter that Android exists? Can I just download apps from somewhere other than the App Store? No. Then within the iOS ecosystem, does Apple have monopoly power? Absolutely. The UK said yes to that question. The US said no, and that's why you're either getting a $55 refund or nothing at all. So here's how the trick works. Apple's legal strategy in the United States is to define the market as broadly as possible. Not the iOS App Store, not even mobile apps, but all gaming transactions, or all smartphone platforms, or all ways consumers can spend money on digital content. By doing that, they can always point to an alternative. But think about what that means for you. If you own an iPhone, you can't access the Google Play Store. You can't install apps from Epic's website, you are locked into the App Store. Period. And within that App Store, Apple takes 30% of every transaction. For developers, that's a business decision. Pay the toll, or don't access 1 billion iPhone users. But for consumers, it's a hidden tax. You never see it. The price of the app or the in-app purchase just costs more because Apple's taking 30% and developers pass that cost to you. The court found that Apple did not engage in unlawful tying, did not illegally maintain a monopoly under the Sherman Act, and that Epic failed to prove any substantially less restrictive alternative for Apple's business model. Apple's executives benefit from a legal system that defines markets broadly and focuses on theoretical competition. Meanwhile, ordinary consumers pay the monopoly premium, with no ability to choose a different app store. The harm is real, the overcharge is measurable, but the legal remedy doesn't exist. Now, the United States isn't entirely ignoring this. In March 2024, the Department of Justice and 17 state attorneys general filed a massive federal antitrust lawsuit against Apple. This one is broader than just the App Store. It challenges Apple's restrictions on mobile wallet competitors, the way iMessage locks users into the Apple ecosystem with green bubbles for Android users, and yes, the App Store monopoly. But here's the critical difference. The DOJ case isn't asking for consumer refunds. It's asking for Apple to change its business practices going forward. Stop blocking third-party payment apps. Open up NFC access for competing digital wallets. Allow alternative app stores. If the DOJ wins, it could force structural changes, but it won't compensate the billions of dollars American consumers have already overpaid. That money is gone. Meanwhile, UK consumers are getting checks. Here's the calculation Apple really fears. The UK Tribunal valued the overcharge at $2 billion for 36 million users over 9 years. That's roughly $223 million per year in one country. The United States has 125 million iPhone users. If you apply the same math, American consumers have been overcharged by approximately $800 million per year. Over the same 9-year period, that's $7.2 billion. Add in the European Union, which has over 100 million iPhone users, and you're looking at another $6 billion. Globally, the potential liability, if every jurisdiction followed the UK model, is somewhere between $20 and $30 billion. That's why Apple is fighting this so hard. Not because they can't afford $2 billion. They absolutely can. But because the precedent threatens to expose 15 years of excessive pricing across the entire world. What makes this dangerous today is that the UK ruling is now a legal precedent. Other countries are watching. If Apple loses the Court of Appeal, which could rule sometime in 2026, the entire European Union could follow the UK's calculation method. Germany, France, Italy, Spain, every EU member state could demand similar refunds. Australia is already considering a class action lawsuit modelled on the UK case. Canada's Competition Bureau is investigating. And in the US, state attorneys general who joined the DOJ lawsuit could attempt to include consumer damages if the federal case succeeds. The same pattern that built a $2 billion liability in the UK could become a global avalanche. For Apple, that means either settling before more countries rule or appealing until they find a jurisdiction that accepts their broad market definition argument. Apple's executives and major shareholders have already extracted decades of monopoly profits from the App Store. They can afford the fines and settlements from their $200 billion cash reserve. Meanwhile, ordinary iPhone users globally have been paying 30% on every app and in-app purchase with no knowledge that competitive rates should be 10 to 17%. The refunds, if they ever come, will be a fraction of what was overcharged. Let's talk about what this means for Apple stock. The $2 billion fine is nothing. Apple's market capitalization is over $3.5 trillion. $2 billion is 0.05%. Financially irrelevant. The stock didn't move when the UK ruling dropped in October. It didn't move when Apple filed the Court of Appeal notice on December 28th. Investors don't care about a single fine. What they care about is precedent. If the EU follows the UK and calculates another $6 billion in consumer harm, and the US DOJ wins its case and applies similar math, suddenly you're looking at 15 to 20 billion in total exposure. That's when the stock moves. But even then, Apple generates over $100 billion in App Store and services revenue annually. They can absorb this. The real risk isn't the money, it's the structural change. If Apple is forced to allow third-party app stores and alternative payment processors, the App Store's 30% take rate disappears. That's a $20 to $30 billion annual revenue hit. That's the scenario investors fear. For tech investors, this case is a signal, not about Apple specifically, but about how antitrust enforcement is evolving. The US has historically been business-friendly, defining markets broadly and prioritizing theoretical competition over consumer harm. But the UK and EU are moving to a consumer protection model that calculates actual financial harm and demands compensation. If you hold Apple stock, the short-term risk is low. They'll appeal the UK case for years, and even if they lose, $2 billion is manageable. The long-term risk is regulatory pressure to open up the App Store ecosystem globally, which would reduce services revenue by 10 to 20%. If you're building a tech platform, the lesson is clear. The US might let you dominate your own ecosystem, but Europe and the UK will calculate the consumer harm and send you a bill. That's the new regulatory reality. So what should you take from this? First, understand that antitrust enforcement has diverged. The US focuses on broad market competition, which allows platform monopolies as long as an alternative exists somewhere. The UK and EU focus on consumer harm within a specific ecosystem, which means companies like Apple can't hide behind Android as a defense. If you're investing in platform businesses, assume European regulations will be stricter and more expensive than US regulations. Second, realize that legal precedent is everything. The UK ruling isn't just about $2 billion. It's about establishing a calculation method that other countries can copy. If the Court of Appeal upholds this ruling, expect EU member states, Australia, Canada, and even US state-level cases to adopt the same 17.5% fair rate model. That turns a $2 billion liability into a $20 billion global exposure. Third, for consumers, the lesson is bitter but clear. Geography determines your rights. UK iPhone users get refunds. US iPhone users get nothing for the same overcharge. The harm is identical. The legal remedy depends entirely on which country's courts you can access. Here's the philosophical one-liner. Financial freedom doesn't come from trusting the system. It comes from understanding which system you're operating in. American tech monopolies are protected by American legal precedents that prioritize innovation and business freedom over consumer harm calculations. European consumers are protected by regulators who calculate that harm in euros and pounds and demand payment. Neither system is perfect, but one sends you a check and the other tells you to buy a different phone. Human nature doesn't change across borders. Consumers everywhere hate being overcharged. But legal systems determine whether that feeling becomes a refund or just remains frustration. The Katz ruling established a £1.5 billion, or roughly $2 billion, fine. But Apple said it planned to appeal, and that the court takes a flawed view of the thriving and competitive app economy. And if you think this case reveals how legal systems protect or punish tech monopolies differently, wait until you see what happened when HPE lobbied its way to a $14 billion merger approval after the DOJ tried to block it. 2 DOJ officials got fired for refusing to back down. 13 states are calling it corruption. That's next. History doesn't repeat, but if you don't understand it, it will cost you all the same. If this gave you a new perspective on how geography determines financial justice, hit subscribe. Patent Wars has the answers. I'll show you where to look.